We have decided to mix presentations up a little bit, and I want to talk to you about a strategy that has been made possible due to legislation changes last year. I want to preface this with the understanding that Australia does not have a death tax. Assets received through the estate generally do not have tax payable, and it's not until the asset is actually disposed of that tax becomes payable. Superannuation is a little different though, and the tax will be payable if it is received by a non-tax dependent, such as an adult child. A common misconception is that since my account-based pension is tax-free, it must be tax-free for my adult children. Well, that's not correct. And it's important to understand that though it's tax-free for you as a retiree, it isn't for your children. Most people's super funds are 100% taxable component, as most of the value of that balance comes from your employer-paid super guarantee and investment earnings over the 40 years of your employment. So why is it a $289,000 problem? Well, if you've worked hard to max out your superannuation up to the transfer balance cap, which is $1.7 million, your adult children's inheritance will be reduced by up to $289,000 thanks to the ATO. So we are 60 years old and retired with $1.7 million in our pension. How do we reduce the tax liability for our children? Well, we withdraw it lump sum tax-free and then contribute it back in as a non-concessional contribution. Simple, isn't it? Well, there's a few things we need to consider. First of all, you cannot control what component you withdraw. So if you just have one fund, you can lower the taxable component, however, it's not very efficient. So after the first recontribution, you'll be withdrawing some of your tax-free component and some of your taxable component. And this is not the only issue we face with this strategy. We need to contend with the transfer balance cap and the total super balance rules. Ignoring the transfer balance cap could mean we could not get any new money into pension phase, and the total super balance rule will prevent us from contributing money into super. Because of the total super balance rule, we need to time our withdrawal and contribution around the financial year, as the TSB is a snapshot at June 30. So if you are retired at 60 now, we can move 1.65 million of our taxable super to tax-free and avoid the risk of the ATO inheriting 280,000 of your children's money. If you're retired or approaching retirement, get in contact with us and we will see how we can help you save on tax for your estate and secure a great retirement.